Hello, my name is Anthony Novoa. I am the founder and CEO of Infinite Wealth Strategy, where I break down the infinite banking concept for you to understand. In this video, we're going to be talking about how you can get 200, 300, 400, even 500% returns on your money just by simply parking it in a place where it constantly earns and works for you. And another beautiful thing about this is that the money is always liquid. So if you're in real estate, if you're a business owner and you're ready for that next expansion, guess what? You can access this money and this money can continue growing even after you access it. And that's something I'm going to break down in this video as well. So let's get right into it. So the first thing we need to discover with infinite banking is that we are trying to become our own banker. Why? Because most people, almost everybody, stores their money in the bank. But what does the money do in the bank? The bank loans this money out. They give it here, they give it there, they're giving it everywhere. But guess what? When they get a return on that profit, do they give you anything? Most likely not. Even with a high yield savings account, you know you're going to get that low percentage. And guess what? Even with that low percentage, you are taxed on those gains. It is not the best place to store or grow your money. So, what does the infinite banking concept do instead? Well, we use a whole life dividend paying life insurance policy. Why? Because in this policy, you get a guaranteed interest that is more than what the high yield savings account gives you, and you get annual dividends, and this money gets to grow tax free. And it works like this: the banks invest money in real estate and loans, and they make money. But most people don't know this, and most financial advisors or infinite banking practitioners don't educate on this part. But the reason why it's possible is because insurance companies invest the money the same exact way. If you don't believe me, Google it. They invest in real estate developments, personal loans, and they partner with financial institutions that do car loans, student loans, and all the above. They also do mortgage loans. They do it all. Everything is the same. But the big difference when it comes down to it is they're going to give you part of the money. They're going to give you your cut, which the banks do not do.
And it literally looks something like this. Banks and insurance companies do the same exact things. But what is the big difference when it comes down to it? What is the big difference? Well, if we look at the benefits that we're getting from both, there's really one you get from the bank. It's a general, safe place to store money. .1% or nothing. Usually, that's what you get from putting your money in the bank and putting all that money in the bank and always having it sit in the bank. But guess what they're doing? You already know they're loaning this money out. They're getting rich. They're getting wealthy. But what are you doing? You're not accumulating any wealth by doing this. It's not working. It's not working for you. What is an insurance company going to do? Guaranteed interest. Doesn't matter what happens in the stock market. It's guaranteed. It's on the agreement when you get your policy. They're going to have to meet that requirement no matter what's happening in the economy. They're always going to meet that requirement. On top of that, you get freaking dividends because as the owner of the policy, you are actually part owner of the company. That's how it works. So policy owners are actually part of the company holders or owners. So it's great. It's great. And guess what? Tax freaking free. What is tax free in this world? Come on. All these vehicles either lock your money away, tax you, penalize you, but guess what? With this, you are going to be growing your money tax freaking free. Nothing better than that. And if you're an entrepreneur like me, you don't want to lock your money away. I don't want. You think I'm going to lock my money away? I need to invest in my business. I need to expand my business. I'm not going to lock capital away. I want it to be available. And that's another thing that this is going to give you. Access or liquidity. When it's time to launch for that real estate property, that development, for expanding your business, guess what? This thing is going to be ready to go. It's the most beautiful thing. And those are the main benefits you're going to get on the outside, that you're growing money. But the most important, most powerful one you get, that I will be explaining later in this video so you can understand, is uninterrupted growth. I think I'm missing an R here. Sorry. Uninterrupted growth. It's not going to stop growing no matter what. It doesn't stop growing, because this is why it doesn't stop growing. Policy loans. I'm going to show you how this works. A lot of stockbrokers like to lie, say, you know what, you're losing money. That's not true. Why would the banks put $200 billion in this asset? Why would real estate developers continue to use it to this day? Why would Walmart, Disney, and all these other great companies use it? Well, this is the truth. This is how it works. Policy loans. This is our graph. How does cash value grow? It grows like this, because it's not tied to the market. That's the beauty of it. That's what I love about it. You're getting a return of investments. There's no ups and downs. This is what the stock market does. Just ups and downs. No predictability, no liquidity. Your money's tied away. So let's say cash value for this person is $60,000. That's how much they put into it. The company is going to charge you for an actual loan. Let's say you want to get $50,000 out. The company's going to charge you an actual $50K loan. Why? Because they don't actually take the money out of your cash value. And you may think this is a bad thing, but this is such a great thing because of the effects of compounding. Guess what? Just like how this arrow is showing the cash value, that money's still earning. It's still going to continue growing. And you end up having more, even if you have to pay for a loan. And of course, the sooner you pay off that loan, either with a balloon payment, either with setting it up to pay it off in 5 years, 10 years, 15 years, it doesn't matter. You're going to end up with more freaking money. And I'm going to show you that now. But before we get into that, what can you use the policy loan for? What can we use the money for? Literally anything. This is your money. The insurance company understands this. You just put in the request and you'll be getting that money within 3 to 7 days. Not like a Roth, not like a 401k, and not like stocks where if you have to get the money out from the growth, you're going to get taxed, right? No, that's not how this works. This is why the wealthy use this, guys. So, on top of getting it 3 to 7 days, there's literally no credit check. It's not your typical loan, guys. It doesn't work that way. And there's literally no application. You just log into your account online like it's a freaking bank account, but it's the insurance account you have with your cash value. Put in the request for how much money you want. You're going to get it within 3 to 7 days. That freaking simple. From their general account. They're not going to actually get it from your cash value. They're going to just loan you an actual loan at 5% interest. And this is how the loan works. I mean, you can pay it off in 6 years. You can pay it off in 1 year. You can pay it off in 20 years, 30 years, 50 years. It's up to you. Okay. So you actually get to set up the time you want to pay back the loan, how long you want to take to pay back the loan. Of course, the faster you pay it off, the less interest you're going to be paying. But let's say for this example, it's going to be 6 years. And again, you can even do a balloon payment. Okay, that's also an option. So let's say if it's a real estate development, as you know, you put that money in, it takes a couple months, a couple years just to get that money back after you sell the property. But guess what? You can just do a balloon payment at that moment and you'll still be more profitable just because you parked your money in a different place. So we're going to use simple numbers here, 50K loan, 5%, 6 years. As you see, typical loan. Balance goes down over time, so does the interest, right? But what we want to pay attention to right here is the total interest, 79.77. Let's put this on the board. So now we need to go to another calculator. We need to go to the compound interest calculator. Why? Well, remember the $50,000 you actually accessed in the cash value was never really taken out. It was always earning during these 6 years. So we have to figure out what did that $50,000 turn into? So we have initial investment, $50,000. We have length of time years, we're going to put 6. And it's growing at a 6% currently with the dividend scale. So you might think, oh, 6% is not a lot. But hey, for a place to house your money where the money's liquid and constantly growing and tax free, that's really freaking good. And if you compare it to the stock market, that's like getting 9% year after year after year. That doesn't happen. So that's why the wealthy house their money here. So let's see what happens within these 6 years at 6%. As you can see, the 50K has successfully turned into 70,925. And that is the future value of the $50,000. So even if you pay back the insurance company for that loan they gave you, guess what? You still come out on top. There was no opportunity lost cost. Okay. You still end up with the better deal. And you know what? The insurance company's happy too, because just like the banks, they got a spread. They got their own profits off this, being able to house your money. They're just giving you a cut back. It's just better. Better deal for you, better deal for them.
So again, no opportunity lost cost. Why? Because the money was always growing in the account. It never stopped growing in the cash value. It continued to compound uninterrupted, continue to grow because they never actually took it out. It kept going up. That's what's happening here in the system. Okay. Let's move on to the next thing. So we already figured this out. But now let's look at the numbers. 60,000. Cash value. And what did we use? We used 50,000 loan. Right? Future value, what did it end up being? $70,925. But that in profit, we're just going to calculate the profit here. 20,925. And the interest ended up being 7,000 $977. So as you can see, after we subtract this, we end up with a positive. That ends up being exactly $12,948 in profit, even though you access the money, even though you used it for a investment, in this case for your either real estate development, either to expand your business. Guess what? Your money was still growing. That's why JC Penney did this. That's why Walt Disney did this. That is why Walmart did this. There's many cases of great entrepreneurs using this strategy. It's just putting you in control and giving you more wealth over time. That's why being the bank, being your own bank, is the most profitable thing you can learn, because you're going to park that money somewhere anyways. So why park it in a place where they're going to keep earning on it and you're not going to get anything in return? This is going to give you the money back. This is going to give you your cut at least. And you don't have to go through a real process of opening up a bank. You don't have to do any of that. You just got to get your own policy going. And this is how the agreement goes down.
So here it is. In year one, you see that on top left hand, I did an example for a age 40-year-old starting a policy. And as you can see in the base, there is $90,000 going in the first year. You see that here in total premium, okay? 90K because of what? The $60,000 lump sum and 30K annual savings contribution. Now, if you see here in the total cash value, there's $73,793 available. That is about 85% available within the first year. Why? Because we're putting the money in cash value, not base, where it all goes to death benefit, where it doesn't grow, where it's not liquid. Look what happens to the cash value through time. Year after year after year, it's compounding and it's growing and growing and growing with guarantees, annual dividends on a tax-free basis. So let's clear the air here. We have a guaranteed column. I know you're probably wondering what that is, and a non-guaranteed. Super simple. Guaranteed means guaranteed interest only. No dividends added in these numbers. But this is the thing. This company I'm working with and I have my policy from, and the one I'd get you a policy from and for you, it's been paying dividends for over 200 years since inception. Okay. They haven't missed a dividend payment in many years. And what I like about this is that the dividends also hold out at a high rate. They don't just change every single year like other companies. This company actually holds it for 5 to 7 years usually. So dividends aren't guaranteed, but guess what? With this company, it's a lot more accurate that this is going to be how it looks. So take a look at this. At year 51, within 11 years of the policy being open, I put the example for this person to cut back on their savings contribution. They cut back to 18,000 a year. And I just want you to know, you can do this within year 1, 2, 3, it doesn't matter. You have flexibility when it comes to this policy. And you can switch to this monthly whenever you like or whenever you have to. It's up to you, okay? Because there's a lot of people that say that there's no flexibility when it comes to this, and that's just not true. You have full control when it comes to the system. And this is one of these benefits I did not mention yet, but look at the death benefit. This comes with the death benefit for your family. And it grows, as I mentioned earlier. So at any given moment within these years, if something happens, God forbid, your family will be taken care of. No other system gives you this. There's just too many benefits when it comes to infinite banking. This brings me to my next benefit to show you guys, and that is At year 66, I put that this person is retiring. They don't want to put any more money in, as you see here, but they're going to start withdrawing 100,000 tax free every single year until they're 81 years old. From 66 to 81, 100,000 tax free. And in year 80, well, when they have 82 years, they're going to be able to withdraw another 33,000. This is an additional nest egg for your retirement, all because you parked your money in a different place where it's working for you and not the banks. As you see, 100,000 from 66 to 81 years old, 1.6 million, 33,000. That is what you're going to be getting. And all you put in, you see it here in the cumulative premium outlay, 634,000. You're going to end up with 150% returns just because you parked your money in a different place. And again, look, age 66 all the way to 80, 86, 90. If something happens to you, look at the right-hand side. Your family will be taken care of. There's still a lot of money to be left for your family. Even when you reach 100 years old, you're still going to leave something for your family. And you still got a return on your investment or your strategy, your wealth strategy, I like to call it.
So we end up putting $634,000 in to our own banking system, to our own policy. And what we ended up with was $1,632,000 out for retirement income, additional retirement income on top of whatever strategy we have going on in our portfolio, as well as this being tax free and coming with a death benefit or an additional estate plan for your family. So, this is why the banks are using this. This is why the wealthy are using this. And what we ended up with total 150% return on our capital. And you don't get that from storing your money in a bank. You can have this in your life. This is certainty, this is predictability, and this is peace of mind for you and for your family. So if you'd like to see how this looks for you and your family, just click the link in my description and go to Let's Connect and fill out the form. I'll see you on the inside.